Okay, so the February 2025 inflation data for both consumer and producer are finally fully out. If you haven't, you can go to my Instagram to follow somewhere around here so you don't miss out on this information. So currently, I only follow CPI, PPI, and PCE closely due to time constraint. I do plan to expand this to wider data metrics in the future, so yeah, do not miss out. Anyway, February 2025 PCE data is finally out, and that means all CPI, PPI, and PCE data for February are fully out. I noticed that there seemed to be confusion amongst people that I figured maybe I should try to deep dive into this, considering I have never really deep dived into this and linked them all together before. So with the last PCE data is out and the tariff imposed by Trump kicking in next week, what the hem is going on with the economy right now, right? Why is the market red? Gold reach all-time high and the dollar dips and yield not going anywhere. What are people actually thinking? I'm Daddy, and this is That Money Compass. Before I started talking about all the stuff, let's start with this, the PCE data. You can see it on the screen here. As you can see, there are mostly oranges and reds. There are no greens. And let's take a look at the CPI and PPI data now. As you can see, they are all greens. The percentages are actually going down. So what is actually wrong with this then? This kind of made me feel even more curious, right? Because my expectations were that the PC data would be in green too, meaning their rates will be going down too. But nope. In fact, if you look at it more carefully, the non-core data shows that the rates remains the same while the core data ticks up. Now, the core data excludes volatile factors like food and energy. In fact, food and energy prices didn't budge much. Think flat gas costs. So what does this mean then? For starter, let's take a look at this. Personal income and personal spending month-on-month data. Both increased, especially for spending, because previously it was in a negative, but in February it was totally positive. But of course, comparing the two, the jump in personal income is less as compared to spending. What did they spend on specifically that affected the core PC data then? It was apparently the services like healthcare, financial and insurance, and also durable and non-durable goods like furniture, appliances, and clothing, household supplies. However, apparently it was the services that really is the main one due to persistent and consistent increase in healthcare, housing, and other services like financial, insurance, and education. So now we have got that out of the way. We have understood why the core PCE data shows an uptick. So next is what's happening right now, right? Naturally, that's the question. So this is where things actually got more interesting, I have to say. Gold price reached an all-time high of about $3,100 while bonds barely moved. The 10-year Treasury yield showed only a slight dip of about 0.26% from 4.5% to 4.24%, while the 2-year Treasury yield, which is more sensitive to Fed policy typically, only had a modest 0.037% drop from 4.02% to about 3.98%. It's really not much. It's basically like barely moving, I have to say. So the stock market, red. I believe you have seen it by now. So as red as you can see, right? So here's the question. When the stock market is red, typically people go to bonds, right? But having the gold reaching an all-time high instead, what is actually going on, right? So I saw some people said it was because of the tariff. However, the data was before tariff, right? And we also had debunked on why the PCE data ticked up, right? So if that's the case, why the fear, right? The negative sentiment on the stock market, right? So Let me explain. The core PCE data is what the Fed is actually looking at. And so when the upticks happened, people start to anticipate that the Fed may not cut rates anytime soon, or will hold the rate as is for a longer time, right? Or worse, he may even hike the rate, right? Depending on the future of economic data, considering their target is 2%, right? Even Jerome Powell mentioned that they are not in a rush to cut the rate. So this data kind of confirms the investors' fear. On top of this, there's still the upcoming tariff. So factoring that in for the future data, the fear somewhat seems more justified in a sense, right? Now, this result definitely didn't come with no ripple effect. This is where yields, gold, and even the dollar come in. So when the data came out, naturally we all know that the rate does have effect on companies. Investors probably know that with this rate remains the same for longer, this means that companies that depend on borrowing will be affected, meaning their margins may be affected for longer. This coupled with the fact that there is a potential hike in rate, this doesn't bode well with those companies. These companies tend to be growth stocks like tech companies that depend on borrowing to grow. REITs also could be a potential one for this one, but tech would probably be affected more. This is more apparent on Nasdaq as it had a decrease of about 2.6% since then. Considering S&P 500 has tech companies as the top bulk of it, hence S&P 500 is down too. Investors don't like the fact that profits will be reduced, so they sell off first, right? So that makes sense. Stock market is red. This explains the market, basically. Next is the yield. Usually when the market is down, cash and bonds seem to be the attractive one. However, as per Saturday, 29 March, I don't see much dipping for the 2-year yield, let alone the 10-year yield. I mean, I actually purposely waited out until Saturday to see like how people are and stuff like that. But yeah, I still don't see much dipping for the 2-year yield, let alone the 10-year yield. This shows that there is not much spike in the bond demands. In fact, the dollar DXY actually dips post Friday. So what's going on, right? Bond and the dollar tend to have positive correlation in the first place, as you can see in this chart. So maybe allow me to start by explaining how, right? Using the current situation where the 10-year yield is about 4.24% post PCE data, the core PCE rate of 2.8%, the real yield is only about 1.44%. All right, this may make investors feeling like meh because they may expect more yield, right? So they may just be sidelining on this. But most importantly is the effect of tariff. This may be the main reason why investors are not jumping into bonds directly. You see, tariffs impact other countries, right? If you haven't watched it, you can watch or you can search in my channel this video, because I made this video about tariffs before to explain how tariff actually works, especially under Trump. So yeah, when trading partners are slammed with more taxes, this may make them to think twice on doing businesses in America. This in turn may affect the demand for the US dollar, because if they decided to diversify and do businesses elsewhere, that means less dollar demand, right? Makes sense. On top of that, countries may also be like, enough is enough, and decided to trade in other currencies other than the dollar, right? This may further reduce the demand for the dollar. And with the potential weakening of the dollar, bonds become less attractive. I mean, foreign investors always look at the strength of the dollar. So if it is weaker, why would I invest in it when I know the converted currency is going to be less, right? Additionally, when investors are piling up on bonds, this means investors would need to buy more dollars to invest in bonds, driving up both bonds and dollar prices, right? So looking at the dipping of dollar with less enthusiast in bonds I think there is just trust issue with fiat overall right now. So the main issue that I see here could be the tariff in this case. So with the stock out, bonds out, cash out, what's next, right? When the sentiment is this negative. Gold money needs to rotate, and gold is like the last resort. Gold's scarcity has always made it the precious one that people can use it to hedge against anything. Countries have it. Heck, China seems to be the one that has been buying the most recently, right? So yeah, it seems like gold is something that is used to hedge against both fiat devaluation and the current geopolitical chaos. So in this case, gold seems to be the better bet when both stocks and bonds pretty much faltering. Yeah. So yeah, inflation risks, tariff uncertainty, dollar being shaky amid tariff jitters, gold does seem like the go-to over here. So hence everybody buys gold. I mean, I even started seeing normies like you and me pretty much started asking how to buy physical gold, where to go to, and how to sell after I buy it, especially when things get better. This is real actually, when people like us actually start to talk about this, because usually it's the traders, the economists, and the people who are really experienced kind of play around with this. But when it's the normies that start to ask about this kind of question, like, is it a good time to buy gold now? Or you can start seeing people be like, just buy gold now, gold is good, just put 2% in your portfolio. Suddenly everybody become financial advisors, you know what I mean? Yeah, this is real. So yeah, alright. So I hope that this explains everything. So maybe allow me to summarize everything. The PCE data pretty much spooks investors, I have to say. Investors started to sell off due to potential grim outlook for companies, causing the market to be red. Since investors need to rotate out, bonds are just not the place here because there's not much change in the rate. Interest is lackluster. The dollar, people's trust in fiat is wavering because of tariff and global political issue. Domestic spending alone cannot prop up the USD, so there's no guarantee there, at least for the short term. So investors then go to gold, hence gold reach all-time high. But I have to add though, with tariffs kicking in next week, things may just change again. So I guess we just gotta stay tuned then, because especially with Trump, all these tariffs things may change. Negotiations are happening. I would pretty much say that this geopolitical issue is pretty much unfolding, I have to say, at least for this first year. So yeah, we just really gotta stay tuned. Anyway, I hope I summarized it well for this video. I also hope that you enjoyed this video and learn a thing or two from this. If you like this video, do consider leaving a like and share it, as it can really help this channel tremendously. Also, if you have anything that you want me to talk about, do leave them in the comments below. I read your comments. I also do consider what kind of topics that I'm going to talk about next. So yeah, until then, stay hydrated and I will see you on the next one. Bye bye.